welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for the next 25 minutes here on Options Guide TV. Well, the markets are what the markets are. It's hard to explain where we're going to next. We do got financials coming out and good numbers on the financials, but not good words. JP Morgan executive Jamie Dimon came out, said that, economy's slowing. In general, that's been the theme. So a lot of the banking companies have that all announced today have started up and now are a little bit down as we get into the midday as far as the markets are concerned. We got the SPX just kind of hanging out, just kind of having some fun for the first day, just maybe relaxing, like sitting on the couch today. Wouldn't that be interesting that we just close one day just flat with nothing going on? Volatility has been insane. And it continues to be insane. We have the VIX index right now trading at, and this is not a good thing for our one trade, but where did my VIX go? 45. We're up $4 on the day today. JP Morgan, as I mentioned, is now up 2.5%. So in the pre-market, it was down. Now it's back up. What else? What other stocks did we have announce in that space today? Let me grab my note and get the rest of it here. BlackRock, Morgan Stanley, Wells Fargo. That's an interesting one. Wells Fargo is an interesting one. See where we're at. That's good to see that. Oh, no, it's down. It said that it was up a little bit, but Wells Fargo is a lot of consumer loans and that. So as far as recession is concerned, Wells Fargo would be one of the stocks that would struggle. JP Morgan, on the other hand, has some trading. BlackRock actually bumped up on the BLK. It is BLK. Nice at up $5, flat. Considering they announced earnings, that I would consider as flat. But BlackRock was a beneficiary of the election in that they thought regulations would open up the room for them to do some deals. The CEO of the company talked about the fact that would like to start to get some deals done. Stock went up, went down, went back up. Very volatile, actually, across the board as far as BlackRock is concerned. And then they announce earnings and they don't move. So that's one of the companies. What else? Morgan Stanley also announced today. And then we got some consumer sentiment numbers. So markets are flat. I guess I take that as a win. If we're getting some of the financials, all of the CEOs are making comments after their announcements, showing a little bit of a weak consumer, but the market is holding its own, basically flat on today. I think that's a good sign. After a very volatile market, we had obviously the White House kicked the can down the roads on some of the tariffs, saying we're going to go out 90 days. It doesn't really change the outlook, I guess. In 90 days, we're going to have to revisit this all again. But the can has officially been kicked down the road, and then except for China, which real tough on what's going to happen with Apple. Apple has been all over the place. It's up a little bit today. It's at 191 right now. And I don't know exactly what. Do they get a break? Do they not? Everybody's assuming at this point in time that there's going to be something done to allow Apple to, I don't know, move their operation. It's definitely, everybody kind of agrees that it's not going to come to the U.S., but something has to happen. And they rented a boatload of 747s to fly as many of the iPhones out of China ahead of the tariff announcement and the tariff war. And I don't know. We'll see what happens. That's a very volatile, very interesting company. As a matter of fact, Apple, even though and we're going to be announcing earnings here soon, this is one of the May 2nd, looks like May 2nd. I don't know exactly when the date is, but that's the week of the expiration. I can go and pull it up in the charts and we can get it from there. But I'll come back to it. If I look at Apple, it might be a candidate actually for a long straddle. Yeah, let's run to the Tradier Pro software. And if you have any questions, please do feel free. This is an interactive show. Put them in the chat box. Let's get the conversation going because it's kind of one of those days. With Apple at 192, you know where I think my trade would be? It would be a long straddle. I don't want to really mess with earnings because you're going to have to pay up for the earnings event. So I could see even going out 14 days. Implied vol is, man, it's high even on the front month, 6 days, 70. Interesting in that you go out to the earnings week and the vol is actually a little bit lower than where we're at right here. And we got earnings to prop it up. Maybe we buy the earnings straddle. Maybe we do that because we would anticipate that it might even go higher going into earnings. But earnings is not going to be the news in Apple. It's really what happens in negotiations over the next 14 days. And something's got to give. I mean, we're talking about billions of dollars in merchandise that could have 100. Well, they're saying the tariff is as high as 140%. Very muddled as far as how much that affects Apple and what they'd have to pay to get their products out of there, everything to go along with it. So news headlines are going to drive it. So it is an interesting straddle, but I'm sure we got to pay up for it. Let's look at it. Now, I totally went on a tangent on this, and we're going to come back. We're going to finish our trades. But you're looking at $10, $20, 10% move. That's very possible, right? So if we buy, get the VIX trade in here, if we buy the at the money straddle in Apple on the 14 days out, 193, this is the most at the money. I think I would probably lean towards the 195, make the put more expensive than the call, because on the way down, I think the path of least resistance is to the downside, but they negotiate a deal. I'm talking 20 points. That's been nothing in Apple so far. I mean, that's a simple move. Yeah, I kind of like that. Let's make that our paper trade. Now, if we do the earnings date, okay, so we're talking the difference between a week, 14 days and 21 days. And I was going to do an SPX trade today, and we might toss that out there. And that's a few dollars more. That's quite a bit more. But we would think that the earnings would keep implied volatility propped up a little bit. But right now, news head, like, if you know, it's just the implied volatility on the 6-day option contract is more than on the 14-day, which is more than on the earnings date week. Yeah, very interesting. Okay, I think we're going to do that. We'll make it a paper trade. It'll be very speculative. It'll be fairly costly because it will be a straddle, and I only like to do straddles. So that's where we're going to go. We're going to look at that. I just talked myself into it. You saw the whole process. I hope I didn't hurt anybody out there trying to see my mind working. But I've always said about long straddles is you don't want to do long straddles on companies where there's an earnings report and the news is anticipated and you know that it's going to add volatility. You want to do it on companies that could get blindsided by news headlines. And obviously, waiting to see what happens with Apple, and every day that goes by and no deal gets negotiated, nothing gets said, it just gets a little bit scarier for a a trillion-dollar company. It's not there anymore, but at one point in time it was. So yeah, I like that. I don't mind paying $20 on that. And realize that whenever you do a long straddle, it's hard to lose the entire amount. You're still paying up for it, but we got that earnings date to try to keep us maybe relevant on implied volatility. In other words, we're going to get out before earnings, but we would anticipate that going into the earnings, you would have an increase in implied volatility. There's no guarantee in this marketplace that would happen, but and the concept is there. Might give us a little bit of protection overall. All right, so I guess we're here. Let's do it. this is going to be the official paper trade. I don't mind doing the 14th expiration, but I'm going to do the 21st. I'm going to pay a couple of dollars more because I think I will get it back in implied volatility. So this is going to be the official paper trade is going to be in Apple. We're going to do a long straddle in Apple. The stock is at 193.74. It's having a strong day, decent move. They must know that we're talking about it because the stock went up about $1 since we started talking. So we're up 1.7%. I think I want to lean to the bear side of things, though. So we got to choose. Either we buy the 190 and lean a little bit bullish on the call side and pay 13 for the call, or we buy the 195 and lean a little bit bearish and pay $11.65 for the put. And I think I'm going to lean that way. I'm going to lean to the bear side. So here's going to be our official paper trade. We're going to look at buying this. We're going to look at buying this. 22.25. I like 22.25. We're going to say that, and I feel like we could get the vol with the way the markets are, how much increase in volume we've had across the board. I think that we could feel fairly close to the midpoint. 22.25 divided by 193.15 equals 11.5% move in Apple. So if we're buying this, we're not going to go out 21 days before we get to that earnings date, and I'll grab the earnings date over here. Before we get to that earnings date, we're going to get out of this trade. We don't want to take the risk of the volatility crunch. If Apple doesn't move significantly in one direction by April 25th, by that Friday, 14 days away, we would get out of this trade for sure. It is saying that earnings date is May 1st. May 1st is what day of the week? It looks like it is a Thursday. So Thursday before Friday. So that'll be an interesting, just in general, to do a trade in Apple on can't be May 1st. June 3rd. Oh, yeah, it is. May 1st is Thursday. I was looking at my calendar wrong. May 1st is a Thursday, and that is the May 2nd, the Friday expiration is what we're going to buy. And that is a good one to try to hold volatility in because they will announce on a Thursday and these option contracts will expire on a Friday. So implied volatility on these option contracts is going to be very high because they're going to end up being a one-day option contract and it's going to be all based off of the earnings trade. So I like this trade even more. We're talking about 11.5% move. Do we think you're only going to do this if you think news headlines may hit over the next 14 days that can push Apple in one direction about 10%? So what we want is we're going to pay, ideally, I'm thinking it's going to be to the downside, but ideally we're going to pay $12.40 for a put, and we want to sell that. If we see this trading for 24, 25, we're going to sell this put and get out. Ideally on the other side too. So, and then we'll let the other side ride. If you want to, I usually always leg out of a straddle. I will sell whatever side it goes to first. So if we get a 10-point down move, then this option contract should be moving right around, trading somewhere close to 22.25. As a matter of fact, I can do the math real quick right here, but it's going to be based off of the current implied volatility and time decay. But if you say this moved 10 points from 195 and it moved down to, let's say, 205, all right, this option contract that is now in the money or at the money would be trading for around $17, mainly because the 205 option contract is 10 points in the money. So quick math says that this would move about a little bit more than $5, and this would be trading for about $17.25. So if it's looking like we would need, That's a 10-point move. A 15-point move gets it trading close to 21. Based off of where this is at, looking at what the marketplace is showing us right now. So you're looking for about a 15-point move in either direction to be able to have one side of our long straddle pay off. And let me go back and reiterate. This is an at-the-money option contract, the 195 is. It's fairly close to at the money. If you move up 10 strikes, that option contract is in the money by 10 more points. So if the market went down 10 points, it would be trading somewhere close to where this option contract is trading, right here, the 1781. If it moves 15 points, it'll be somewhere to where this option contract is trading, right around the 2115. Now, this is saying as of today. So tomorrow, if implied volatility moves or something, it's not extremely accurate, but it does give you a feel, right? I like to look at the option change to say, all right, I really want a 10-point move, and I'm expecting a 10-point move in Apple. That's only 5% over the next 14 days. And if that is the case, well, then this is where my option contract may be trading for. But I don't mind this trade at all. It's just the fact that it's a little bit expensive to get into it. You're looking at $2,225 just to do a 1-by-1 straddle. So if you do a couple of these, you're talking about some real money. Now, also realize that you can't, well, more than likely, you're not going to lose all of it. If you did, you'd really get the stupid award. It means you rode it all the way to expiration, and it stopped right at 195, and you didn't get out a little bit earlier on that trade. So that would be a real bad luck scenario, but it's everything's possible, right? So let's send this to the what if calculator so that I have it, so that I can take my screenshot a little bit later on. But this is as of today, and you got the smiley face going on. The market's at 195. Like I said, you could go down, excuse me, and do the 190 if you wanted to lean bullish, or you do the 195 if you wanted to lean bearish. This is where we're at right now. Every single day that goes by, we're going to start seeing the smile kind of work its way on down. But it should be a little bit slower because we have an earnings report. So we would anticipate that over the next 14 days, implied volatility increases on the option contracts that we have bought. We will get out of the trade prior to that earnings. I do not want to ride this trade in particular through earnings, but that earnings report is giving us an implied volatility buffer. Now, this was totally off the cuff, just talking about Apple and everything that's involved, and realizing that we're in the middle of earnings season. We're paying up for this to start with because we're going to buy that expiration that has earnings. But I do think that it gives us a small buffer. So once again, we got volatility going with us, I think. I can't 100% say that in this environment, but Apple normally would trade at 25% implied volatility. What was the historical? 54 is what the historical is showing right now, but ideally Apple usually trades like the SPX. It's very similar to an index. There's been many periods in its life where it traded around a 25% historical implied volatility, sometimes 20, somewhere in that range. So now it's saying the historical is 54 and the implied is 62. So volatility crush is an issue. By buying the earnings, we should have a decent, a little bit of decent protection. So I do like this trade. I'm going to put this one on. I'm not going to do it big. I mean, honestly, if I would normally do 5 contracts on a trade like this, I'll probably do 2, right? I'm not going to do 3. I'm going to lean to the little bit of, just because you're paying so much premium up in this marketplace. But I will definitely put this trade on. I like it. Now let's go back to where I was. We got to review all of our other trades. We did, and I jokingly said in the description today that we were able to make a dead cat bounce. And what I'm talking about is the Disney trade. There was strong support where Disney was at, and President Trump coming out on Wednesday and kicking the tariff can down the road helped. And we got a pretty solid move up in Disney. So let's look at the Disney trade. It was a win-win, right? So here's right where, and we were highlighting it on right in this area. And if you go all the way back in the chart, if you go way, way, way back, this area is about, even after the COVID lows, this is below the COVID lows, and there was solid support. So we were looking for that dead cat bounce. Now I got a real strong bounce on that Wednesday when everything went up. And then we stayed solid on the next day, and we're still above that right now. So Disney right now is trading at what price? 80. Wow, we're almost back to where we were. So we could almost do it again, rinse and repeat. But the option contracts that we sold, if we go to the what if calculator, we take the Disney trade. We're going to send this to the ticket. It's trading for a dime. So we sold the 81 and bought the 86. The market was at around 83, right about where it's at right now. You could do it again. I would probably wait till Monday. But every single time that we come down to this level on the chart and we don't break down, but every time we come down to that level, let's go way out. Let's add the days. Let's go 2,500 days and show this area of support. So every time we come down to this area, obviously COVID, obviously we're lower than where we actually ended up after the COVID downturn, actually lower than that. And just look at these areas of support right in here. 79, 78, a whole bunch of congestion right in this area. So I'll put it this way. If we do break below 79 on the Disney chart, I think that's about right. If we do break below that, then you want to get bearish. I don't know how you wouldn't want to do some type of bearish trade. Hopefully it will hold. So it came back and retested 1, 2, 3 times, and it held on that one. I don't even, this is just a mess right in here. Right about 82 is, well, 81 is actually that, and that's why we sold the put. I remember that. That's why we sold the 81 strike put. But that's also real interesting. So maybe we do another Disney trade, looking, selling and put spread, hoping that resistance area holds. It's another trade that we can look at. So that was a winner. We paid $1.25 for it. I would close it out. I would, with the way the market is right now and the fact that it's down 2%, it actually has dropped since I started the show. 83.55 is where we're at. Pay a dime. Remove that risk. News headlines could hit at any second, and you never know what, especially in this marketplace. If you are short put spreads, if you are short premium, please close them out. Pay the dime, pay the nickel, get rid of them in case of that news. Because you saw what happened on Monday or on Wednesday, and we're already giving that back. And I kind of anticipate that we'll probably be back to those levels on Monday morning. I just, no major news has happened. The only thing that can really stabilize the markets is if we can get a little bit more solid news from the banks, a little bit of positive comments. I think everybody right now, their bank earnings have been great. JP Morgan knocked it out of the park. Everything's been fairly solid. I didn't see the Wells Fargo one, which was a little bit more consumer based, and they're down a little bit. So I'm not really sure where that one is at right now, but that is one thing that could keep us a little bit stable. I do anticipate that earnings will be fairly decent this time around, but everybody will be leaning on the guidance and what the outlook is for the consumer going forward. So, VIX. We had an opportunity in the VIX, and I want to get out of this one trade. And I already have in my own account, and I've gone long the other VIX trade too. What if? There we are. Dang it, I have a real bad frog. Excuse me. Here we go. if we look at the VIX trade, we have one that's going to be expiring on the 11th. That's the 5th. That's the one I really like. Long put vertical. This should be calls. Send to the what if. Okay, so it's trading for around 250. We put it together for 105, and we sold the 31, bought the 36. We did it for $1.05 in the account. There was an opportunity based off of the VIX chart, and on Wednesday, at the end of the day, we had obviously a huge run up in the VIX, and the VIX came crashing down. The futures didn't move as much, but the actual VIX index moved quite a bit. And we see this volatility in this here. And we came all the way down to below 30 on the VIX, started out, and now we're all the way back up to the 45 level. So once again, we kicked the can down the road. Another 90 days, nothing has really happened. There's not been any announcements of big deals being done. There's been some extraneous news about conversations that are being had and people wanting to negotiate, but there's really nothing that has came solid. So the marketplace has put back the uncertainty and the market is down. I would think Monday is going to be another down day, mainly because we had such a big up day on Wednesday and people are kind of coming to their senses that this wasn't great news overall for the markets because nothing has necessarily changed. So here's where we're at. I would close this out. I would not do this trade going into Monday. You paid $1.05 for it. It's now $2.05. You could have closed it out for around 50 cents on Wednesday. The futures, and when I looked at it, it had came down to about the 26 level. Now the futures are back up and they're above 30 at this point in time. So because we're getting closer and closer to the expiration date on the VIX. And this is our trade that we have on 31, 36, 45. If we once again look at our futures trade, and if you go to my X profile, you can read about decoding the VIX, and it talks a little bit about what I'm doing right now. But I'm just trying to look to see where the call and the put line up, and that's right at 38. The bid on the call is 515. The bid on the put is 515. So that futures contract is morphing towards the spot. The fact that the VIX is way up today on a flat day, well, now we're down 0.5%, is a sign. It really, I guess they're not really liking where the financials are at. And I would bet that on Monday we're going to be lower. So since Wednesday is the expiration date on the 16th, if you're not out of the VIX trade, I would get out of the VIX trade. I'm out of the VIX trade. I closed it at 75 cents, but it got down to about 50 cents at its low range. So made 50 cents on a trade, got out of it, a lot of risk. And and the bigger reason why I got out of that trade is the fact that I went a little bigger on the May expiration. So let's see where the May's at. There still might be an opportunity to get into the May. Something's got to give. There's just too many days. And we already saw for a minute, there was using the White House term, there was fake news saying that Trump was going to remove tariffs. Something about tariffs going away, and the market literally jumped and went from about 5% negative to 5% positive in about 10 minutes. So if anything like that happens, the VIX is going to collapse once again. And so if we see the May expiration, and I'm only focusing on VIX, right? Not the W's. I'm just focusing on the VIX. let's, now that we had another spike up today, man, that's a scary move after what happened on Wednesday, to see so much more uncertainty in the marketplace happening right now. There it is. Okay. And I do see a couple of comments. I figured that. Oh, Anthony, good, Anthony. Yeah, I got it for 75. So, Anthony, we put that up there. Anthony, are you talking about the VIX trade? You let us know. And that's the VIX trade. Okay. A good time to close. Yeah, way to ride the momentum. I got out for about 75. Okay, and Anthony says yes. Thank you for sharing. Sharing is caring, Anthony, and I do appreciate that. So we go all the way out to the May expiration, and I liked this trade better. 31.36. Let's send that to the what if calculator, and then let's look at that expiration date. I think that future's even spiked a little bit. 35.36. Okay, send a ticket. Trading May 30.36. We did that for about $1 or $1.15. I didn't write that one down. Somewhere around $1 to $1.15. It is $1.15 now. So it's staying pat. So yeah, that trade is still viable, mainly because of this move up in the VIX. And where do we got the market? We scroll down. Where does the put line up with the call? Oh, we're down a little bit here. Right about here, 32. Yeah, so we're 620 on the ask, and we're 660 on the bid here. So it's a little bit below 32. So let's buy this one, and let's sell that one. Quite a bit. So minus 170. All right, let's clear that out. Let's synthetically. Oh, I didn't want to clear the trade out. Shame on me. 30. Yeah, right here. Let's buy that one and let's sell that one. Send it to the what if. That should be synthetic long future. Yep, it is. 30 cents. So 31. I'm sorry, 31.30. 31.30 is where the future is at right now. And it's trading for 115. So if you believe the market can go below 29 over the next 40 days, and the market will settle down. The marketplace doesn't think so, so don't discount that. But I like this one a little bit better than our shorter term trade, and we got lucky that we got the rally that we did to be able to get out of that trade on Wednesday. And Anthony was smart enough to actually close it, to realize that it was a news-based headline, and that was an unprecedented move that we had on Wednesday. And as part of the reason why I do think that it's going to come back, or that the market's going to, the recession concerns are still there. The market hasn't changed. JP Morgan still upped their chances of a recession to a 60% chance. Goldman Sachs, I think, went to 55%. Was it 45 or 55? Somewhere in that range. But bottom line is everybody's raising their chances of recessions, and big names even like JP Morgan. So that hasn't changed because we said we're going to kick the tariff can down the road. All right. So, all right. That's a lot. I know we're at time, but I was going to do a bear put butterfly. Do you guys want to do it? You want to do an open wing butterfly? I need to get a thumbs up in the comment section, or we're going to call it a day, because we're way over 11:36 right now. All right. I guess we'll let it ride. We'll call it a day. That's a lot. The paper trade is going to be the Apple trade. I am going to put it on. I'm going to put it on in very small numbers. Like I said, if I would normally do a 5 lot, I'm going to do a 1 or 2 lot. I'm not even going to lean to the 3 side, right? I'm going to lean to the lower threshold because it's very expensive, very speculative, and you're basing it off of the fact that something's got to give in Apple. Something has to happen. The stock hasn't necessarily tanked relative. The fact that it's up today is befuddling, actually, considering that everything is at risk. Here's where the chart is at in Apple. Yeah, I mean, strong moves up in the middle. This is where there was a rumor that they were going to get a break on the tariffs, but nobody has confirmed that. 190 broke below the 200-day moving average. We came all the way down to here almost, right? So 165 is in play. That's 30 points lower. That is very possible. And the gap up, if we fill the gap, we're talking about, to get all the way back to that's another 40 points. Yeah, I even like it better that we're paying $20 for the long straddle, looking at the chart. So that move's very possible, right? Very feasible. You could, and it could be a thing where you wake up and the stock actually gaps up or gaps down 15 points. Like, that's very feasible. This is the time that I like looking at long straddles, but now realize that most long straddles, they're priced that 7 out of 10 of them don't work. And it's a very feasible thing. So be aware of that. But I don't plan on losing the entire $22 because it would have to go out right at 195. So realize that if a week goes by and we're sitting here right at 193, applied volatility should go up a little bit, I would probably just get out. If the stock hasn't moved in a week and it's staying right at 193, if we get momentum in one direction or the other, well, then we stay the course for another week. But we're going to get out before earnings. All right. I guess comments came in. Fresh Prince and Anthony, Kurt saying, yeah, sure. Kurt, what does sure mean? Does that mean maybe? I'm not really sure. So sure? All right, sure. Why not? All right, we'll whip it together real quick, and I'll take a screenshot of it. Let's go to Wednesday. I just think Mondays have a tendency to be more volatile days on the downside. The fact that the VIX is way up means the butterfly is going to be cheap. So it's kind of a shame to not, with the VIX at 40, to not look at a butterfly. It gets any higher, butterflies almost become free. That's a joke, by the way. 525. Make sure I get this right, guys. I've done this before where I don't get the Wednesday expiration. Wednesday expiration is the 16th. Wednesday is the 16th, 5 days away. All right, that's what we're going to look at. No reason to go all the way out to Friday. Like I said, vols are high. Butterflies are going to be cheap. You might even consider doing this on Tuesday if you want. If we do Wednesday, it does give us a chance to adjust. But, man, an adjustment is scary in this marketplace. So I kind of look at it more as an all-or-none type trade. We have our adjustment in our back pocket if we want to do it. 52.70, 52.65. Oh my gosh, $119 option contract. April 16th. Wow. Well, you got to fill at the midpoint. Yeah, I got the right expiration. That is just crazy. All right, here we go. Buy. Maybe we'll go 20. Let's look at 15. Sell to. So this is an open wing butterfly. There's 15 points. Then we'll go 10. And buy. We're in the SPXW. SPX 416. God, I can't believe those options are that expensive. Wow, $2. I would say 220 is solid, but $2 is feasible. Normally, the market 161. The market's at the money. Normally, this would be 280, 5 points out of the money, but now it's hard to say because the market's moving so fast. But so I'd throw it in at 2 if I were to do this. I don't know if I'm going to put this one on, but I would throw it in at $2 if I was going to do it. And I do, and you could even start at 190 and give it a few minutes and then try 2. And that's where I'd be at. Now, this makes me almost want to go a little bit more open on my wing and maybe pay another $1 more, which is the normal amount of risk I would take on. So let's see what happens. Okay, let's send this to the what if calculator. We'll make this, and this will be the screenshot that I'll grab. This will be the trade that I will follow. Okay. But let's adjust this. Let's do it a little bit different. Let's get rid of all of it. It's just easier to start from scratch. Let's go 160 by, let's go 20 down to 52.40, sell 2, and then we'll go down 15, 42.25. Yeah, that's not, yeah, why not, right? Has the market moved up a lot? Yeah, it did. Okay, so now you're 266. Yeah, I don't mind that. $2. Maybe we do put this on. Maybe we do. So we're 20 points wide. And then you're 15, 20, 30, yeah, 15. Okay, send us to what if. We want to see, make sure that it's opened, make sure I did all the math right. And it's always makes sense to send. I love this about the what if calculator, just to make it so that are you thinking what you're thinking, right? Are you thinking that this is open? So we're looking at this, we're getting, and this is unprecedented. This is 20 points. So this, the maximum upside could be 20. If it went out right here, you got 2 days for expiration. Down here, if you paid, it looks like it's saying about it's grabbing, so it's saying 265. So from this point on down, it's worth $5, depending on what you pay for it. It's saying $2.45 because you got $2.65 here. I'm looking, I would probably go 220 on that. That's probably where I would put that one at. And let's try even one more. Let's go another 5 points. Man, when we get such high volatility, we are in it. I'm not doing anything weird, am I? I'm kind of surprised. I guess I'm befuddled by $100 option contracts going out 5 days. That really kind of blows my mind. What is it saying the implied vol is? 49, which isn't outrageous, right? So it's historical vol is 36. It's saying these options are trading at 49 vol. I guess it's hard to get 49 vol usually in a SPX option. So let's try one more. This is actually kind of fun. Okay, 56.20. And now let's go 25 points. So 35, let's hit that twice. And now we go 20 points. Man, that gives us a wide range for it to land in. 20 points goes down to 25.15, right? Holy cow, 230? The market jumped up. Dang it. I guess I could adjust it to the 265 to make it apples to apples. But gosh, this is interesting to me. Send to the what if. Not a ton of risk, but a decent amount of reward. And if you just even a normal 1% move to the downside, this thing could land at our middle strike. which on the upside here would be saying 2,000. Like if you look over here, this is where it's at, 2,200. That's where the profit and loss is at. If we landed on expiration somewhere close to that, based off of, 230, 245, I'd even be willing to pay 250. And this, I would go wide. Huh. Want to go one more? What happens if we go another 5 points? 275. Market stop. I'm trying to do an experiment. All right, we're going to move up to the 52.65. Yeah, we got to be. Normally, we start 5 points out of the money. That's normal. That's what the goal is. Buy. So now we're going to go 30 points, I think, right? 55, 45, 35. Sell twice. And then we're going to go 25 points. All right. So 10, 25. Buy. Now you're looking at 270. The market keeps running up, though. Now we're up 10 on it. I'd wait a little bit closer to the close. Do as much as 30 points wide, but vol is so high that it's almost like no matter what butterfly we're doing, we're paying 250 for it. Man, that's interesting. And then see the upside here, 2071. It cranks all the way down. We can make 100. Well, we're paying a little bit more. So it's saying that we got 5 points that it would be trading for. It's saying that we did the trade for $4. No, it's 250. Okay, 250. No, it's 250. I'm looking right here. So it's saying we can pay 250. That's what the profit and loss calculator grabbed when we came over here. The what if calculator is another word. All right, what do you guys think? Thumbs up on the SPX trade? Do we think we're going down on Monday? Give back some of this gain that we got on Wednesday? We've already given a little bit back. I don't know, maybe some news just hit because the market ran up 10 points, but that's nothing in this marketplace. All right. Not really seeing any questions or comments, but thanks for playing in my reindeer game and staying longer. We're almost at noon. Wow, this might be the longest Options Guide TV ever. Look at this going into the market. I would, a couple of bucks for the potential. The risk reward ratio is just wonderful, just in general on the trade. So thanks for stopping in. We'll see you Monday for the next edition of Options Guide TV. I think it really applies, but stay safe out there in this marketplace. It's a scary time to be in the markets, but you want to trade accordingly. Keep your size relative. Keep it small. If you're scared by a trade, like I am in the Apple trade, that's a great example. I'm less scared in this SPX trade than in the Apple trade, but the Apple trade has potential to give great rewards. Gosh, we're already up $5 in Apple right now. So the lot's going to happen just probably over the next week in Apple, and that's what I'm anticipating. Thanks for stopping in. Hub.tradier.com. Please check us out. See all the great speakers inside the Tradier Hub that Tradier sponsors. Please check out the website, Tradier Pro. Awesome profit and loss graph, awesome option chains, very easy order entry. Love the website, and we'll see you Monday for the next edition of Options Guide TV. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.